Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries hidden within financial filings and leave you smarter than you were when you clicked. Today we're diving deep into the latest report from MOVEIX Inc., a company that's been on a real journey. Alright, so MOVEIX Inc. has just dropped its quarterly report for the period ending June 30th, 2025, and let me tell you, it's quite a read. This tells us about the company's financial health and its operational story right now. Let's start by looking at their balance sheet, which is like a snapshot of what the company owns and owes at a specific moment. Looking at June 30th, 2025, we see total assets are listed as just 833 tours. Now that's a very, very small number for any publicly traded company. And for December 31st, 2024, it was $845, so not much change there. On the liability side, we have 16,000 T's entry dollars in accrued expenses for June 2025, up from 4,000 December 2024. And then there are notes payable to related parties, which are $1945,555 due $2,000 at $1.77 and $117 and $117 and $806 in December 2024. This signals they are borrowing from people connected to the company. Now, the real story here is the stockholders' deficit. For June 2025, it's a negative $2097.22.2, and for December 2024, it was negative $180.192.2, and for December 2024, it was negative $180 right now based on these figures. Remember those almost non-existent assets? This deficit is a pretty big red flag. Let's move over the statement of operations, which shows how much money the company made or lost over a period. For the 3 months ending June 30th, 2025, the company reported zero revenue. That's right, folks, zero. And they had administrative expenses of $1,286. This resulted in a net loss of $1,286 for that 3-month period. Looking at the 6 months ending June 30th, 2025, the picture is similar. Zero revenue again, and operating expenses of $2,502. Now let's compare that to the same period in 2024. For the 6 months ending June 30th, 2024, they also had zero revenue and $525,000 total operating expenses. So for the first half of 2025, the company incurred $287,162 in expenses with no revenue. In the first half of 2024, they incurred $525 to $1.25 on operating expenses, but they are still not generating any income. This next statement, the statement of changes in stockholders' equity, really shows how the owner's stake in the company changes. Starting from December 31st, 2023, we see a stockholders' deficit of $100.65.28. I'd always have an $1 deficit grew to $114,646, $146, $1.61 to $1.46 to Then by June 30th, 2024, it had widened further to $159.91. Fast forward to December 31st, 2024, and the deficit is now $180.61. Then finally, on June 30th, 2025, it stands at a hefty negative $297.22. You can see a clear trend here. The company's deficit is consistently growing, meaning its losses are accumulating and the owner's equity is shrinking. Now let's look at the statement of cash flows. This tells us where the company's cash is coming from and where it's going. For the 6 months ending June 30th, 2025, they used $1,649 in operating activities. This is mainly due to their net loss. Before that, for the same period in 2024, they used $525. They managed to cut back on cash used in operations, which aligns with the lower operating expenses we saw earlier. The good news for their cash situation is that they received 1,649 Tantrum-related party loans in the first half of 2025, compared to 525, compared to 525, compared to $500 aberrations, essentially borrowing money from insiders to keep the lights on. Interestingly, the report states they had zero cash at the beginning and zero cash at the end of both these periods. This highlights their extreme reliance on these related party loans. Going back to the notes to understand the business, we see MOVEIX Inc. was incorporated in Nevada back in 2016. Originally, their plan was to sell electric transportation products like hoverboards and electric bikes. Quite a shift from what seems to be happening now. A significant event happened on December 31st, 2020, when Custodian Ventures LLC was appointed custodian of the company. This often means a company is in financial distress or facing legal issues. Then on July 2nd, 2021, a big change occurred. Most of the company's shares, including a significant chunk of preferred stock, were transferred from Custodian Ventures LLC to Cardone Ventures LLC. To Cardone Ventures LLC, the report describes this as a private transaction where Cardone Ventures became the controlling shareholder, paying $250 through. Following this transfer, Brandon Dawson, a prominent figure in business consulting, took over as CEO, CFO, and director. Under the significant accounting policies section, we see the critical going concern note. This is where management addresses if the company can survive for the next 12 months. And here it is in black and white. The company states that its operational cash flow is not enough to fund its operations. This directly raises substantial doubt about its ability to continue as a going concern. They mention they need to raise more funds through financing like selling stock or taking out loans. They also note they've used stock for consulting fees to save cash. They also mention that preparing financial statements requires management to make estimates and assumptions. This is normal, but it's worth keeping in mind that these are not always hard facts, but educated guesses. And about cash, they explicitly state that on June 30th, 2025 and December 31st, 2024, their cash equivalents totaled zero. This reiterates their dire cash situation. This section details the related party debt again. The loans come from Cardone Ventures and are interest-free, which is a benefit, but it also shows the deep reliance on this single source of funding. In the equity section, we see 10 million shares of Series A preferred stock and over 87 million shares of common stock outstanding. The preferred stock has dividend provisions and conversion rights into 10 shares of common stock for each preferred share. They are also non-redeemable unless both parties agree. Now let's look at the management's discussion and analysis, or MD&A. This is where management explains their own view of the company's situation. They start with a standard cautionary note about forward-looking statements, basically saying that their future plans might not happen. They mention the impact of the coronavirus pandemic and their lack of operating history as risks. You might recall their initial plan was electric transport, but they haven't really gotten there yet and are looking for a new business opportunity, a reverse merger. The plan of operation states they have no operations from a continuing business other than expenditures related to running the company. They are in the process of developing a business plan and are looking to acquire another business through a reverse merger. They admit their limited capital resources mean they may only be able to achieve one business combination, which is a big risk due to lack of diversification. Under liquidity and capital resources, it's quite blunt. We have zero cash on hand as of June 30th, 2025, and will be dependent upon loans from our new principal shareholder to remain operational. This pretty much sums up their current financial state. Here we see a critical note on controls and procedures. The CEO and CFO concluded that their disclosure controls and procedures are not effective. This means they might not be reliably capturing and reporting important company information. They also cited material weaknesses in their internal control over financial reporting, which is a serious concern for investors. Finally, the exhibits list standard certifications and XBRL data. So what does this all mean for MOVEIX Inc? Well, the story here is pretty clear. MOVEIX Inc is a company in transition, or perhaps stuck in a very early stage of development. They have minimal assets, no revenue, and a growing deficit. Their very existence seems to depend on funding from related parties, specifically Cardone Ventures. The management themselves admit that their ability to continue as a going concern is in doubt and that their internal controls are not effective. They are actively looking to acquire another business through a reverse merger, which is a common strategy for companies that have shell structures and need to go public, but it's a high-risk endeavor. The lack of diversification is also a major concern, because if their future business plan fails, there's no other income stream to fall back on. In essence, MOVEIX is currently a shell company with no real operations and significant financial challenges, all funded by a controlling shareholder. While the pursuit of a new business opportunity could change their trajectory, it's a highly uncertain path with significant risks. Investors should be extremely cautious, as there is no current indication of profitability or sustainable operations. This report paints a picture of a company very much at the mercy of its financiers and still searching for its actual business identity. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.